We're sitting right here, right now, on the third breakout. We've come off this bottom all the way up. We're obviously not here anymore, but we're nowhere near the top. Based off of these things, it looks like this market has a long way to go. But if you're a long-term Bitcoin hodler like I am, and you expect it to hit $1 million by 2030, like I do, you're gonna stop reacting to price and start positioning ahead of it. Because right now, the signals say we're entering a new regime.
Throughout history, the global monetary system has only undergone a few major transformations. The 1940s saw World War II, sovereign defaults, and the birth of the Bretton Woods system. In the 1970s, the US decoupled the dollar from gold, triggering energy shocks and ushering in floating exchange rate. The 1980s brought a final attempt at coordination through the Plaza Accord. Today, according to macro analyst Lynn Alden, we're entering a fourth major transition, one that isn't negotiated in a single moment but is unfolding gradually through inflation, liquidity shocks, supply chain disruptions, and a more multipolar world. Lynn sees more than just short-term noise. She identifies deep structural cracks in the foundation of the dollar system. A long-term debt cycle is nearing its peak, and the strong dollar era is losing steam. Meanwhile, U.S. policymakers are trying to fix trade imbalances and revive domestic industry, all while holding on to the extraordinary privilege of issuing the world's reserve currency. The system is under pressure, and the consequences could be far-reaching. In this video, we break down Lynn Alden's macro thesis: how debt, trade, and currency cycles are converging, what a meaningful dollar devaluation could set in motion, and why the cost of maintaining global financial dominance may soon outweigh the benefit.
A lot of people get this wrong, so let me break it down for you. GLI stands for global liquidity. Global liquidity. Now, where a lot of people get this wrong is they look at USM2, but we're talking about global. Bitcoin is a commodity, it's a global asset, and we want to look at the global liquidity. Now, I believe the absolute master in this game is Michael Howell. He talks about the impact of global liquidity. He says the biggest and most direct impact comes from global liquidity. Seems like we should be paying attention to it. Let me tell you why. All right, so we don't want money, we want goods and services. Goods and services is wealth. So when the government prints more money, sends it out as stimmy, that doesn't make more wealth. They can't print wealth. So what we really have is all the money of the world divided by all the goods and services of the world. As they print more money, the value or the price of those goods and services go up. So if we look at liquidity, as they increase it, then we know that it has to go somewhere, and it's going to go into these assets. They're going to go up. That's why it's the driver, okay? This is the leading indicator, not a lagging indicator. Okay, so he says it's the most important thing, global liquidity. He says that Bitcoin is not a substitute for global liquidity, not a substitute, but rather it's a barometer. So it's a way to read it, a way to gauge it, right? A way to tell us what's going on. What's more is it is a truly global asset. Again, Bitcoin is a global asset, so we can see what's going on with India and China and Japan, not just the United States. Whether China prints money or the US Fed injects liquidity, either way, the price of Bitcoin should rise. It's the most sensitive asset to global liquidity.
This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to portfolio, tap your Solana asset, then click close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
All right, it's like a sponge, it soaks it up. A little bit more from Michael Howell, again, the king of global liquidity in my mind. In this article, is a two-piece series he was writing, Bitcoin and Global Liquidity. He says that debt denominates. So when we're talking about global liquidity, a lot of people want to know, like, what is it? And where you go wrong is just looking at M2. It's a very rough way to look at it, but because we're in a debt-based monetary system, all money is created through debt issuance, debt creation. So we want to be looking at debt, okay? So we want to look at the money, yes. We want to look at the availability of credit, the ability for central banks to create more money, okay? So it's that. Debt dominates. So what he's saying here is that Currently in our system, in this debt-based monetary system, debt never gets paid. It never gets extinguished. Instead, refinancing existing debt. So we always refinance it. We kick the can down the road. Refinancing existing debt with about 75% of transactions now involving debt rollovers, this creates a dependency on collateral. This is why we can have no deflation. When debt is issued, so money is created through debt issuance, the debt is the asset. The dollars are the liability. The debt is the asset. So the debt becomes the asset or collateral for more debt. That's what he's saying right here. So we have to roll the debt over. We can't pay the debt off because it's collateral for more debt. So it has to get rolled over. It creates a dependency on collateral. We can't have a deflation. It says, i.e. global liquidity, the financial system is trapped in a debt refinancing loop. So we're trapped. We have to continue to roll it over, and in order to roll it over, we have to create more of it. All right, we're trapped in this system. There's two ways out. We continue forward, inflating the system in a debt-based monetary system, or we let the whole thing collapse and crash and we start over. Now, there's no politician in the world, or banker, or elite, or whoever that may have any control or say is going to allow this system to crash and see what happens next. It's always going to be continued. That's why we're trapped in the system. Policymakers need to continually expand liquidity, right? So all those doomers out there that are calling for this market crash, they don't understand the basics of the system that we're in. Okay, let's go a little bit deeper. Now, Michael Howell uses these charts. I use them all the time, so you probably recognize these. This is the global liquidity going back to 2021. So it went up, and then we had this big crash. Here in 2022, October 22 was when we were in like that bear market. Everybody's saying the world's going to end. The markets are all crashing down. I started making videos saying there's no market crash coming. Here's why. And it was because of this liquidity cycle starting. Now you can see here is just since this year, and we've had a big run up in global liquidity this year as well.
Lynn Alden argues that every few decades, the global financial system reaches what she calls a structural midpoint, a moment that goes beyond typical recessions or debt cycles and marks a fundamental shift in the rules of monetary engagement. The last such midpoint occurred in the early 1970s, when the Bretton Woods system collapsed, gold was removed from the monetary equation, and the US dollar became a free-floating, sovereign-backed fiat currency. Today, Alden suggests we may be approaching another major inflection point. But unlike in 1971, when President Nixon's actions marked a clear break, the current transition is far less defined. Instead of a single event, we're seeing a slow convergence of systemic pressures that together signal deep structural change. This shift is being driven by a combination of forces: the economic aftershocks of the pandemic, intensifying sanctions and tariffs, rising geopolitical tensions, and a global debt burden so massive that currency debasement may now be the only politically viable option left on the table.
Okay, now here's another chart on global liquidity. I mean, you can just go Google search this and find any number of charts. I like this one here because it kind of shows us a couple different levels here. So in the green right here is the global M2 growth. The blue line is the global M2 supply, the money supply, and then we're overlaying it with the orange or the red line, which is the Bitcoin price. And so what the green is the year-over-year change. So you can see we had this massive print of global liquidity during the pandemic, right? 2020, 2021. And so this pushed the price of these assets sky high. Global liquidity went up, the Bitcoin price went up because of this massive volume here. Then we had this big drawdown, both in global liquidity and in the Bitcoin price, coming down as the year-over-year, month-over-month changed and liquidity drained out. And you can see here, it's starting to pick back up, and of course, both of them are turning back up. So you can start to see the correlation of this. I've done a bunch of videos on this, and you have to understand it's also important to realize it has somewhere between like an 8 to 12 week lag. Most people just consider it 3 months or 90 days. Okay, so that's the global liquidity. Here's the chart on TradingView. Again, I just want to show you can get these charts from anywhere. I like to pay for my information. It's a much faster, easier way to get it. But this is just TradingView. This is my charting software. And you can see the Bitcoin price and global liquidity, and you can see how closely tied they are together. So these are the leading indicators, okay? Global liquidity. Now the next thing we have to understand, remember, the fuel is the global risk score, and we call that GRS. Now this is where we start to get into some of the predictive power of what these things tell us, because again, we're looking for leading data. Not lagging, tell us what already happened. We want leading data to tell us what's going to happen. Okay, now these charts are from Jamie Coutts over at Real Vision. He's an absolute master in these. And this is the Global Liquidity Index, GLI, and he's talking about the GRS, the Global Risk Score. So the Global Risk Score, it tracks how far Bitcoin's price deviates from its liquidity. So if the liquidity is driving it up, the risk is when it starts to deviate away from the liquidity. That's what this tracks. It's implied fair value based on a regression model, regression from the liquidity. It says here, it shifts GLI, global liquidity, from being just a macro backdrop to an actively usable risk management tool. So for risk management, see, most amateur investors just think about how much money can I make? Tell me the hot crypto to buy, right? And they just want to buy it, YOLO in, hopefully, cross their fingers, they make money. But professional investors always want to think about the risk. That's the name hedge funds, like hedging the positions. It's always about risk. And so we want to use this as a risk management tool. Even when I'm going long to make money, I need to know how big I should bet, how long I should go based off of the risk of that cycle. And that's exactly what this is going to break down for us. So let me show you what we're talking about. Okay, now the first thing we have to understand is that liquidity, like most things, it moves in cycles. I talk about cycles all the time. Okay, so what we can see, and in this case we're calling them regimes, is we can see that this liquidity moves up and then it consolidates in a pattern. Why? I've done a bunch of videos on this, but it's because the debt has to get rolled over. It's about an average of 4-year cycles of debt. On year 3, we start running out of liquidity until the next tranche is put in. Then we're off to the races for the next 4 years. So we have this upcycle liquidity. We have a consolidation pattern, and here is the breakout, okay? This breakout puts us into the next Super Bowl cycle. And now we take off, we go into a consolidation right here, and then we break out, consolidation right here. And the reason why I'm showing you this is because we're sitting right here, right now, on the third breakout. Now, if you're an elementary kid looking at patterns, we have a consolidation, breakout, consolidation, breakout. Here we've had a consolidation, and we're breaking out. What do you think happens next? Well, if you see this arrow shooting up, you would be exactly right. But again, we want to understand, one, we're in this breakout of this regime shift, but we want to look at the risk. Okay, so how does this work? Again, this is from Jamie Couch. This is a global liquidity risk score. And basically we have 5 levels. Level 1, level 2, level 3, level 4, and level 5. You can see that. And this is overlaid with the price of Bitcoin, going back here to 2017. And of course, this is current right here. So what this shows us right now is that we are currently at level 3, which is basically neutral. Basically neutral, right? We're not at the Bitcoin lows right here, where we're back here when we were only at 1. We've come up a lot in the Bitcoin price, but we're only at level 3, a neutral score. We're not at 5 yet. What does that tell us? Well, it tells us we're sort of like at a medium risk. We're not the lowest risk ever, but we're nowhere near the top either. So what this tells us is potentially Bitcoin has a lot of room to go up from this $100,000 price point that we're in before we start getting into level 4, level 5 risk. Now, even when we get into level 5, we can keep going for a long time. These do not predict absolute tops. They only let us know when things are cheap, level 1, or expensive, level 5. That's it. So you can see here, we hit level 5, but look how long it continued onto that pattern.
To grasp the full stakes of today's monetary shifts, we need to zoom out. Lynn Alden identifies the end of quantitative easing in late 2014 as the beginning of the current strong dollar cycle. Since then, we've seen U.S. asset dominance, subdued inflation, and increasing strain on emerging market. But if history is a guide, a weaker dollar phase may be next, and the consequences could be significant. Past cycles show that every dollar peak since the 1970s has been lower than the last, reflecting declining global tolerance for a weaponized currency. During previous weak dollar regimes, value stocks outperformed growth, emerging markets surged, commodities rallied, and capital rotated away from the U.S. and into international asset. These patterns aren't just coincidence, they're rooted in financial mechanics. With over $18 trillion in cross-border debt denominated in dollars, a weaker dollar shrinks those liabilities in real terms, giving foreign economies more room to stimulate and grow. But this dynamic is part of a much bigger structural issue. Alden describes the architecture of dollar demand, trade deficits, and capital flows as the cost of reserve currency privilege. In the Bretton Woods era, the U.S. paid that cost by bleeding gold. After 1970, for more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.